This video is for educational and historical purposes only. It does not contain financial advice. It's December 10th. Today, the Federal Reserve reduced the policy rate by 25 basis points, bringing it to 3.5 to 3.75%. While this may look like a simple number on a screen, historically such decisions have influenced global expectations in different ways. Interest rate changes have, during some periods, affected credit conditions, borrowing trends, and general market sentiment, though outcomes are never guaranteed and vary considerably depending on broader circumstances. When the Fed makes an adjustment, global markets often revisit their assumptions. Yet the way markets respond is far from consistent. A rate cut in one era might coincide with optimism, while in another era it might have minimal or even mixed reactions. That's why interest rate decisions should not be viewed as predictors of future results, but rather as policy tools whose impacts depend on many evolving factors. Everything discussed in this video is based purely on economic history and general analysis. But what exactly is interest? Where did this concept come from? And why does such a small shift sometimes echo across civilizations? To understand that, we must travel back 4,000 years. Imagine a morning in ancient Mesopotamia. The sun hasn't risen yet. A thin layer of fog hangs over the fields. A farmer stands in his granary staring at an almost empty sack of barley. There are months left before harvest. If he doesn't sow his field, his family won't make it through the year. He goes to his neighbor and asks for 100 measures of barley. He promises to return 120 after harvest. The extra 20 measures are among the first recorded examples of interest in human history. Archaeologists have uncovered clay tablets detailing these agreements etched carefully with wedge-shaped cuneiform script. Each symbol represents a hope, a risk, a promise. The farmer believed nature would be kind. The lender believed the farmer was trustworthy. Yet both knew that disaster lurked in every season: floods, droughts, pests, or illness. Early interest was not greed. It was insurance against the unknown forces that ruled their world. But the story doesn't end there. If the harvest goes poorly, the debt cannot be repaid. And if the debt cannot be repaid, the farmer may lose his land, his home, even his freedom. Ancient clay tablets record heartbreaking lines. "He who cannot repay shall serve the lender." The king declares a debt forgiveness. The people shall begin anew. Interest was powerful enough to shape destinies, and in many ways it still is. Kings occasionally issued full-scale debt cancellations, not out of generosity, but out of necessity. When too many people became enslaved by debt, productivity collapsed, armies weakened, and social unrest grew. A society trapped under unbearable financial burdens could not function. These ancient resets, echoes of what we now call economic stimulus or debt restructuring, show that even in ancient times, leaders understood the dangerous balance between credit and collapse. In ancient Egypt, interest rates were tied to the Nile's cycles. Grain, oil, and wine were common lending units. A merchant once wrote, "If the Nile overflows, abundance lowers interest. If the Nile retreats, scarcity raises it." Interest followed the rhythm of nature. Egypt's economy breathed with the river. Prosperity wasn't measured in coins, but in the height of the floodwaters. When the Nile failed to rise, tension spread through villages long before famine arrived. Farmers knew a poor flood meant higher borrowing costs. Interest itself rose like a warning signal from the earth. Even thousands of years ago, finance and nature were inseparable. Greece, a philosophical battle. In ancient Greece, interest sparked ethical debates. Aristotle famously objected, "Money is barren, it cannot give birth to money." He believed interest violated nature itself. But as trade expanded, ideas changed. Ships sailed farther, risks grew, and lending became essential. Interest shifted from a moral dilemma to an economic necessity. The bustling ports of Athens told a different story than Aristotle did. Merchants returning from long journeys faced storms, piracy, and war. Their cargoes were vulnerable, and financiers who funded these voyages demanded compensation for the danger. Slowly, society accepted a new idea. Interest wasn't unnatural, it was the price of uncertainty. The seas taught Greece what philosophy tried to deny. Rome, where law meets finance. Rome treated interest as a legal institution. Limits were imposed, contracts formalized. A Roman senator once said, "The state collapses not from high taxes, but from high interest." In Rome, interest regulated not just personal debt, but social stability. Roman law carved financial order into stone, literally. Debts were recorded on wax tablets, sealed, witnessed, and stored. Citizens understood the weight of these agreements. Failing to repay could result in imprisonment or forced labor. Yet Rome also recognized that overly harsh financial pressures weakened the empire. Their early regulations foreshadowed modern monetary policy: stabilize the people, stabilize the state. The Middle Ages, sin, trade, and the rise of the financial shadow empire. In medieval Europe, charging interest was considered a sin, usury. But trade was expanding, cities growing, merchant networks spreading. Money was needed everywhere despite the ban. This opened the door for a new power: Jewish bankers, who were allowed to lend with interest. In Venice, Florence, and beyond, great banking families rose to prominence. The Medici family became the backbone of European finance. Behind cathedral walls, sermons condemned interest. Outside in the marketplaces, merchants secretly sought it. The growing economy could not survive on moral restrictions alone. From these contradictions emerged underground financial networks: private ledgers, encoded letters, discreet couriers. This hidden financial architecture became the skeleton upon which Europe eventually built its modern banking system. Interest, even when outlawed, proved essential. History taught us one simple truth: if society needs something, it will exist, even if forbidden. The Industrial Revolution. The 18th and 19th centuries changed everything. Machines, steam engines, railroads, all demanded capital. Entrepreneurs borrowed, banks expanded, and interest became the fuel of industrialization. Britain used low interest rates to kickstart industrial growth. Germany leveraged controlled rates to build heavy industrial power. The U.S. developed modern banking through lending systems. Interest could now shape nations. Factories rose where farmland once stood. Cities swelled with workers, and the clock replaced the sun as the measure of a day. Every new invention, from spinning machines to locomotives, needed financing. Interest rates determined which dreams became reality, and which remained sketches in a notebook. Economies were no longer driven by seasons or rivers, but by the availability of credit. The birth of the Fed, modern monetary policy, begins. 1913, the Federal Reserve is established. This marks the beginning of the modern financial era. Its goals: maintain low inflation, support employment, stabilize economic cycles. And it uses one primary weapon: the interest rate, a number that can slow or accelerate the world economy. With the Fed's creation, economic management shifted from reactive to strategic. No longer would panics and bank runs be accepted as inevitable. By adjusting interest rates, the Fed could influence millions of transactions without issuing a single command. It was subtle power, like adjusting the temperature of an entire continent by turning a small dial. Today's financial system revolves around it: how interest rates work, the invisible accelerator and brake. Historically, when interest rates decreased, borrowing tended to become more accessible in certain periods. Spending and investment activity have, at times, increased. Some markets have shown heightened activity during low-rate environments. Historically, when interest rates increased, borrowing costs rose in many documented cases. Spending slowed in some economic cycles. Businesses sometimes reduced expansion plans. These historical tendencies do not guarantee similar outcomes in the future. The same policy move can result in completely different effects depending on global conditions, political developments, market sentiment, and countless other variables. This section should therefore be understood as a reflection of past patterns, not a prediction or a guide for financial decision-making. History's turning points, when interest rates shook the world. The 1970s, oil crisis and 20% interest rates. Inflation exploded. Fed chair Paul Volcker raised interest rates to nearly 20%. The consequences? A deep recession, soaring unemployment. But inflation was crushed. The U.S. economy regained stability, a brutal but necessary reset. 2008, zero interest saves the financial system. The global banking system collapsed. The Fed slashed rates to zero. This decision saved the stock market, saved the banks, saved corporations, saved the economy. But it also inspired Bitcoin's creation. People questioned, can we trust central banks? The crisis exposed deep vulnerabilities: mortgage fraud, excessive leverage, blind optimism. When the system cracked, fear spread faster than the collapse itself. Zero interest rates were not just a policy. They were a lifeline thrown to a drowning world. Yet the rescue came at a philosophical cost. If a system requires extraordinary intervention to survive, is it truly stable? 2020 pandemic shock and the crypto boom. The world shut down, the Fed cut rates to near zero. The result? Stock markets hit all-time highs. Bitcoin reached $69,000. Liquidity flooded all risk assets, inflation skyrocketed later. Interest cuts can reshape entire asset classes. Investors who once shunned risk suddenly embraced it. Trillions of dollars flowed into markets, fueling exponential growth across entirely new sectors. It was a period when people felt anything was possible, a strange contrast to the chaos unfolding outside. But like all booms, the bill eventually arrived in the form of historic inflation. 2025, what today's Fed decision might indicate. Some analysts interpret today's rate cut as a possible sign of moderating inflation, an attempt to prevent economic over-tightening, a modest easing of financial conditions. These interpretations are general observations, not assurances. Economic outcomes to policy moves are never certain. Historical examples show both positive and muted reactions to similar decisions. The purpose of this discussion is strictly educational and historical, not predictive. A 4,000-year story with a new chapter beginning today's rate cut is not an isolated event. It represents the continuation of a story that began with a farmer borrowing barley in Mesopotamia. A story shaped by kings, philosophers, empires, and modern central banks. Interest is not just a number. It is a reflection of how societies value risk, time, stability, and growth. For 4,000 years, humans have been asking, what is the value of time? And with each rate decision, and whiteward including today's, that question is revisited. The story continues, and we are watching one more chapter unfold. Final safety note. Nothing in this video constitutes financial advice, investment guidance, or a prediction of future market performance. All descriptions refer to historical patterns, economic theory, and general observations. Real-world market outcomes can differ significantly.